this morning when we hit $73, I said, well, that should be the end of it. And so far it has been. We peaked out at 17. I think we got two, where are they? Two short contracts right about $73. And at the moment they're up $850 for the pair. So, you know, I mean, I'm not inclined to take the money and run here. You have to think about what lies ahead. We're in the middle of September. There's nothing going on holiday-wise at all. I mean, what holidays do we have? Do we have Columbus Day? That's not a real holiday. There's no major travel thing or anything like that until Thanksgiving. So, what is this? No, that one, what day is it in November? The Memorial Day? No, that's Veterans Day in November. So we have Veterans Day weekend in November. And that's not a real holiday, but that's when we usually have our Vegas conferences, because it's a good time to travel, because you can kind of get the weekend off if you do that, but it's not a real holiday where people aren't working and getting things done. So your family doesn't put pressure on you to go somewhere. Anywho's. Hang on a second. Oh, now we call. Terrible timing. Let me see, what was I going to say? Right, so there's no major demand surge coming up. We have a pretty good spike here though from noon. Basically, we bottomed out at 9:30. Bottomed out when the market opened, and since then we've been climbing. And now we got a big spike up at noon. Not quite sure what actually happened at noon. Didn't see anything particular to send the market flying higher. Oil took off early ahead of the inventory report, but the inventory report was on the whole not that exciting, and so we calmed down a little bit. I just don't see any major catalysts here, so I'm kind of comfortable with the short. So I think I definitely think it's good for more than $1,000. You know, could have taken it off with $1,000 here, but I'm thinking we see 70 again. 70 will be, significantly more money. It's $3,000 more. So I'm not really inclined to jump on 1,000, even though it's a lot of money for one day. Oh, I see. It's too small. Control. Well, you guys can get these things on your own screens, you know. There you go. See how big that is? But anyway, so nothing very exciting going on here. I'd say the biggest takeaway would be just refinery capacity. It's a short-term thing. You have lower capacity for the refinery and a holiday, and that's why you get your draws on the product. But when they start putting it back up, which isn't going to happen right away, it's a slow rebound for these things. Then we should see a bit of a build start to come back in. That hopefully will drop in price. We're still last year it was $37. Now it's $69 for oil. It's double last year. Gasoline also double from last year. That's crazy, huh? Everything's doubled, all these costs. So energy costs this winter doubled what they were last year, basically. And that's going to be nasty. Oh, and natural gas. Holy cow. Natural gas is out of control. Look at that. We're at 538. Let's see on the daily chart. Look at this run it's been having from $4 to $5.50 in basically a month. So that's been totally crazy, man. We'll see what happens. All right, anyhow, so what's been going on? Not a lot. Honestly, there's not much going on. So hopefully you guys have some questions. We'll be able to talk about those. You know, we've been finding stocks to trade. And I don't know if they were top trades. I don't know if I'm sure something was a top trade. Let's see. So the last one we did was September 8th was KHC. And we had two different ways to play KHC. How's it gone since then? So they haven't really gone, actually, certainly flat at best, maybe even down a little bit, but they're going to hold this line, I think. That's the point. And I said 36.50, it's 36.20 now. But they make plenty of money, and long term, it's a good hold. So I like the conservative play. We're getting called away at 35, which is below where we are now. But the net entry for the stock is 29.50, so if 29.25. So if you get called away at 29.25, if you get called away at 35, you've got a $5.75 profit. That's perfectly good on 35. Plus, you're going to collect your dividends, and your dividends are going to pay you a nice 27%. Wow. Oh no, that's total. So the total profit in 16 months is going to be 27.8%, which is better than 20% return annually. That's what you want. In the long-term portfolio, we turned it into a spread that can make 275% of upside. It's a little more fun if you can do it that way. So that's why we have different kind of portfolios, because for the dividend portfolio, we go way more conservative. We buy the actual stock, sell puts and calls with it. And in the, what the heck is that? Sorry. Really trying to get hold of it. Maybe I have to wait. And then the more aggressive way to play it is basically just pick up the, we're taking 25 of the things. Notice the obligation is, it's actually a lower obligation. People talk about risk. My risk here is only 2,000 shares of KHC at 30.87. My risk here is only 1,000 shares of KHC at, it's a $5,000 spread. So basically, we're going to be at 40, I think. Let me make sure about that. If we're spending 5,000 on the spread, then yes, our net cost would be 40. Let me see where we are here. So that is an aggressive sale, but cost-wise, you're only obligating yourself for $40,000 versus here you're obligating yourself for $60,000. But that's the difference. So what we did is we chose to be very aggressive with the put sales and sell the 40 puts, even though the stock is at 36. And why is that? Because it's the same thing, really. It's just a comfort level that you're going to have. Because if the stock drops to below 35, let's say the stock's at 30, then we buy 1,000 more at 30, and our average is 35. So it's not that much different than the averages here, which is 31. So the risk is not, you're not taking on a tremendously larger risk by doing these things. And obviously you're not even taking that risk on. Your risk is owning the stock at 40,000. So if it's at 30, you would lose $10,000 more dollars here than you would on this trade. After that, it's the same. So, you think of a dividend spread as being conservative, but it doesn't really have a lower risk. It's like you have to get your head around like how much money am I actually risking in this situation? Anything below 30, of course, they match out and they're going to lose the same amount of money. In fact, actually, I'm sorry, with the dividend, you lose more because you have 2,000 shares instead of 1,000 shares. So down to 30, you lose a little bit more money with the option spread, but if you go below 30, you start losing the same, you're going to lose the same amount of money on the way down from there. And in fact, you'll lose less money on the options in a major wipeout. Here's the other one. We also liked Halliburton, and Halliburton we liked in the long-term portfolio for straight up spread. And again, same thing, selling $20 puts. Halliburton's at 20 basically. Oh, it certainly was at 20 when we did the spread. So with Halliburton at 20, we sold the $20 puts. So we're willing to buy the Halliburton itself. And then we did 40 of the spreads. And here we only spent $3,500, and it's a $20,000 spread. So we have $16,500 worth of upside, which is 471%. There's no reason to own the stock. It's because if you how are you going to make $16,000 trading Halliburton? Well, if you buy 1,000 shares, it has to go up $16. If you buy 2,000 shares, it has to go up $8,000. That's the math. So in between that, you could sell some calls, you can do this or that, but the bottom line is you have to put a substantial amount of money down, $20,000, $40,000 to get anywhere near this. And what we're playing this for is at $20, where it is now flat, we make $16,500. That is the genius of these kind of spreads. Our worst case is we own it at the current price, and we might lose the third. Now, don't forget, when we look at this worst cases, we say we're spending $3,500. We're not going to necessarily lose $3,500 before we get assigned. We can pull this trade with some money in it. Right now, the bull call spread is $11,000. If we take the bull call spread off the table before it sinks below $3,500, then we've recovered $3,500. Our net cost would be zero. So that's also something you need to realize when we talk about these trades and we talk about your worst cases. I'm not, every time we do a trade, I can't get into this whole lecture about how it works, but you guys got to realize that's not a real number. We're not going to sit there like idiots and lose the entire amount of money from the bull call spread. And if we don't do that, if we recover $3,500 out of $11,000, then our worst case scenario is owning the stock for 20 bucks. So the question is, how much risk are we really taking? We're taking the risk of owning 2,000 shares of Halliburton at 20 bucks. Realistically, is Halliburton going to go to 10? That's very, very unlikely to happen. It did go to, look at that, I went to 4. See, it's not never going to happen, but it's not likely to happen. It came back pretty quick, but holy shit, that's crazy. By the way, this is why we want cash in our portfolios, because when shit like this happens, you want to be ready to buy. You do not want to be sitting there worrying about closing out your positions and performing triage. When you've got tons of cash in your portfolio and something like this happens, you go, oh my God, let's buy that. That's just crazy. For no reason whatsoever. Halliburton, well, for COVID, but come on, it went to $4. It obviously, it came out to, this is like $5, this is $6, but $5 even for Halliburton is so crazy. But because that did happen, everybody's obviously freaked out about it, which is why we like it for the options. That is really nuts. So I did not realize it went that low. But you have to say, what is the reality of my risk? So even if it goes to $5, you're risking, well, that would be a $30,000 loss, because you got 2,000 times 15 would be a $30,000 loss. So you risk losing $30,000 if it stayed down there, but realistically, we don't think it's really going to stay below 10, in which case we're risking $20,000 on this spread. And that's our maximum risk. And that's if Halliburton drops 50% in price and stays down there. And that's also saying we also wouldn't be smart enough to cover it. Because if we covered and sold some calls for $3 even, we're going to knock $6,000 off that $20,000 loss, and it's $14,000. And remember, we do this along the way. We sell some calls to cover. We pick up some extra cash, and then if it comes back, we sell some puts. We adjust it, whatever, blah blah blah. But all that is, down the road sort of thing. But you think of like, what's the worst thing that's going to really happen to this trade? It's probably not going to lose more than $20,000. In which case, from an allocation perspective, you're only looking at this as being a $20,000 block so far. You're using $20,000 of your allocation block because there's really not a scenario in which we envision it being worse than this. And of course, that's why we have the short-term portfolio, because that kicks in and pays for those worst cases. But for the long-term portfolio calculation, we would consider this a fairly small trade, even though it seems like a large trade with 40 longs and a big position here, but we paid for it with these puts. And like I said, you have to realize what the math is. We spent net $3,500. The asset that we have, this is an obligation, right? We have this obligation to buy 2,000 shares for $20. That's our obligation. Our asset, though, is this spread, which is worth $11,000. 11,000 minus 75, 35. That's where it came from. Now, if we recover the cash from this spread, we still only put 3,500 in, so whatever cash we recover here comes off the 35. So if this drops down to 5 and we cash it out and say this isn't working well, we're going to stick with the puts and we're going to cash the spread. And you guys see me do that a lot because this is why. It's because you're conserving the cash. So if we cash this in at $5,000, we have now dropped this net to $1,500 credit. That's what we've done. We've now paid a $1,500 credit for the spread. So now, whatever that is, 75 cents below. So now 1925 becomes our basis for Halliburton. Now, of course, we wouldn't be doing that unless Halliburton was seriously failing this line at 18 and we give up on it or whatever. And in fact, let's consider that too. I could tell you where it's going to happen because Halliburton 2023 trade. So what is it, the 10-20 spread? Forgot already. No, it's a 15-20 spread. Okay. So the 15s have a delta of 78. The 20s have a delta of 61. So the net delta between them is 17. All right. So at what point do we lose? I'm sorry. So currently it's 7 minus 430 is what? 270, 370, 270. So currently it's 270 times 40, I believe it was. Did I do that right? Is 108. It's $10,800. That's about right. I said $11,000. So currently you're about 270. All right. And I'm saying, at what point do we lose 5,000 bucks? When does it go down to 135? Well, if the net delta is 17, that means it will take 5 times 17. 85 is roughly half. So it's going to take a $5 move down in Halliburton before we lose $5,000. So now that's another aspect of this trade then. This thing won't drop below $5,000 unless we're down around $15. At that point, this could be worth $5,000. Now, at that point, we're going to have a choice. We're going to decide whether we're going to roll the 15s down to the 10s because we'd be down $5 at $15, $16 line. So we might roll these down to the 10s and sell some more calls or do something else. We have these puts that we'd be sitting on, or we may cash it in. Like I said, we may cash it in, turn this into a credit. So at 15, let's say we cash this in, turn it into a credit, we end up paying $19.25 for the stock at 15. What's our loss? 425 times 20 is $8,500. All right, so you can use the math to know exactly what your risk is and know exactly what you will do at each inflection point. And that's so, when we talk about the P&L for the trade and so on and so forth, we know all these factors. When we're reviewing our portfolios, we always look at this stuff and we know how we're supposed to be performing and what our trades cost. And as long as we manage that effectively, we don't have to worry too much, right? Because you can see, also, this is what I love about these spreads. The delta of the spread is only net 17. This spread is in the money. So we don't care about the low delta for making money. If Halliburton goes up anything over 20, we make our money. Only if it goes lower. Only this trade, because we sold the $20 puts, we bought the 15-20 spread. This trade will make $16,500 unless we're below $20 in 18 months or 16 months. Anything above or even flat, we make this money. If it goes down, we know, we just discussed that, we're going to risk $8,500 of loss. So what's my portfolio margin on this trade? Realistically, $8,500. I don't expect to lose more money than that. It would be extremely unlikely. And that, but the problem is, obviously, the problem with any plan. What is it Mike Tyson said? Everybody has a plan until you get every boxer has a plan going into the ring, which lasts until you get hit in the face. And this is a hit in the face. I mean, this is what it is. You might have a great plan, and you might be sitting here in the same position we're in, and you say, oh yeah, we're good until 15. And then the thing freaking drops from 24 to 15 in what, 2 months? Or really, I mean, drops from 24 to 22, which we would say, who cares? This is not a big deal at all. No worries, blah, blah, blah. Then a month later, it drops from 22 all the way down in a couple of days to 14, 13 even. So that just blew past. Now, if you were really strict about it, here's 16. So right about here, we should have kicked in and made an adjustment, either sell or make an adjustment, right, to not ride this thing all the way down. That should have been done right around here. That would have been the plan. That's what you trade. Failing to do that, that's what happens. You're stuck. Once it's down here, you're stuck. You're trapped. Because now you've lost, what do we say? We average 19.25. So now you're down 15,000. Now you're down $30,000. Now still in the long-term portfolio, we have $100,000 allocation blocks. We didn't think we would lose more than $8,000 on this trade, and now we're down $30,000 at this level. So do we liquidate? What do we do? And the answer would be no. We have a $100,000 allocation block. We have 2,000 shares of Halliburton at 15, and now the price is 5. So what do? That's obvious, right? You buy 2,000 more for 5. It's only $10,000 not to liquidate. You drop your basis from $19 to $12.50. And that's without selling any more calls or anything. Okay, so without selling any more calls or doing anything, if you buy 2,000 more at 5, you bring your basis down from $19.25 to roughly $12.50, and then we would wait, and then you want to wait for a comeback to sell some more calls or do whatever. Now in this case, we would have waited a few months and been boom right here. Now again, you got to remember, when you double down, you get back out when you get even, unless you have a really good reason not to. That's what you should be doing. And then you would reduce back to the original, but now you've got the original amount of shares, 2,000, at the lower basis price, which would be $12.50. So then you would ride the rest out at $12.50, and then we'd be pretty happy, basically, after that. But that's what it's all about. I mean, if you're going to hold these trades, okay, very important. This decision has to be made here. So when you're looking at this chart, you have to say, okay, this is where I'm supposed to do something. I'm either supposed to roll The current position lower. That was plan number one. Plan number two, I'm supposed to cash in my bull call spread because now, given that these were uncertain times, we would not have spent money to roll the bull call spread lower. You know, in the middle of the market crashing, you don't jump in there and spend money to roll. You're not doing anything but improving a position. That's not worth it, right? You don't. If you're in California and the fires are raging all around your house, you don't paint it. That's not the solution. So that's what it is. I mean, you're basically just, when you roll, you're improving the position to allow you to make profit at a lower strike. Would have worked, but it would have worked after some tremendous pain. And what we don't do is we don't spend our cash in a crash unless it's something that's going to make a tremendous difference that we are sure about. In the middle of a crash, they're better off buying, obviously buying short positions or holding on and waiting to see what happens and where the music stops. Now, portfolio can go down quite a lot though while you're watching this, and you have to be prepared for that too. But if you're a value investor, and this is the thing though, if that happens to AMC, I'm sure it did. Oh, you can't do that here. Let's see. So if you're in AMC and it goes, actually, AMC never went the other way so much. It's funny, interesting. Maybe, oh, I'm sorry, in this chart, here you go. Well, if you're in AMC and it goes from 15 to 2 to 7 to 2 to 5 to 2, at some point you got to say, I shouldn't buy it unless it's a 2. That's probably the smart thing to do, is not buy it unless it's $2. Then it goes from 20 to 15. To 5. Sorry, it's 5. It goes from 20 to 5, back to 15, back to 10, back to 70. Oh, Jesus, 70. That's so funny. And anyway, blah, blah, blah. So, when you have no idea what a stock is worth, that's one thing. But, Halliburton is a real company with real money and real earnings and so on and so forth. So we know what it's worth, and that's, it's not that hard. I like my, if I can find it, no, it can't be that. That thing. There you go. Stockopedia, that's what it is. I like this, my favorite right now. So Halliburton. I like it because I like this, the bankruptcy, you just get an idea of whether they're financially healthy. It's very nice, a quick look in case there's a problem. And the earnings breakdown is lovely, and you can flip to, you got to pay for Stockopedia, that's the only thing. Let's see, and then you can go to all the detailed accounts and see all their stuff. It's very nice. So I'm very happy with it. For me, it's like, that's all I care about. When I'm in Yahoo, all I care about is the financials, and this takes me right to the financials. And and you can play with the chart. That's another nice thing. You can just flip the chart. I think you can do that on Yahoo, but the chart's too small. But me, I'm a numbers guy, so I look at that. So, meanwhile, people were right that Halliburton in this shutdown with the virus and all that was going to lose a lot of money, and they did. They came off a losing year, which is fine for a cyclical company. They spend money, they make money, so on and so forth. But they came off a losing year. They were supposed to be starting to get profitable in 2020. They went the other way, in fact, and took a big hit. Now, one of the nice things is they don't have to pay taxes for a while. They got a loss, a little profit, a loss. But you have to realize when you're buying, you're buying the stock. I'm not buying the stock from last year unless they had a financial issue, which they don't, which is nice for a company of size. They don't have a financial issue. They had a huge amount of write-downs, but they weren't cash write-downs. They're in good position. They're a very healthy company. And so we're not playing this company. We're playing the future of Halliburton, which will be for a few years. They'll have an up cycle. There was not a lot of investment in energy last year. Obviously, very little investment in energy. We're winding down our wars. That sucks for Halliburton too, because they do their infrastructure work overseas. But they also are into solar projects, and that was where I actually got interested in Halliburton. I was like, oh yeah, it's like, the same kind of infrastructure they use to destroy the world, they can also use to fix it. So You just have to point them in the direction of something good instead of evil. Instead of constantly pointing them to evil, you point them to something good and say, hey, build a giant solar farm. And they're like, oh yeah, we could do that, sure. You know, we don't have to build like, you know, we don't have to build fracking systems or anything like that. We don't have to like destroy the groundwater. We could actually like do something. We could build a water treatment facility if you want. But just usually they don't. Usually they go the other way. So, but the key for Halliburton is for sure, there's plenty of work ahead because there's been very, very low investment in the energy industry for a long time. And, you know, look, it's like investing in a mechanic. Like, okay, if you don't fix your car for 5 years, right, you can probably get 5 years out of your car and not fix it if you're lucky. But you know, once you hit that 5 years, I would bet pretty heavily on the mechanic. The mechanic's going to make some money from you in the near future. That's what happens when the oil companies don't invest in infrastructure and rebuilding. Eventually, these things break down, wear out, so on and so forth, and you can't avoid it. Even if they're losing money, even if it's killing them, even if they have to borrow money, they've got to get this stuff done. Otherwise, they just go out of business. They're not folding up their shop and going home. So we have a very positive cycle in the energy industry for Halliburton, which is a huge portion of their money, but then also infrastructure projects of all sorts all around the world, especially solar, renewable energy, things like that. They're all over this stuff. So I think they're going to be in very, very good shape. So, you know, it's a cycle. That's why they call it a cyclical company. And people just don't know how to play cyclical companies. You've got to look at the years, not look at the months, not look at the quarters. You got to look at the years and see where they are. So I like these guys. Okay, I don't love them. If I loved them, I would have picked a higher strike than 20. But I like them. I think they're value-wise, this is very fair. And since the options reflect this volatility, we're getting some fantastic prices. And that's what makes a trade. You know, I mean, a lot of times, you know, we look at a company and it's like, oh, that's a nice company, but the options suck. You know, if the options aren't good, then I don't care if the company's great. I don't care if it's going to do well. It's got to have realistic options that we can play and make a fair return on. Because if not, there's 9,000 other companies we could be looking at. Then we had Boyd Gaming. That's another good one. And Boyd's just a good middle market casino, very nice to play. Here we got actually pretty aggressive. We went with the 55-75 spread because they were testing the 55 line, and I was pretty sure this was going to hold, and it did. It was August 30th. That's just way up here anyway. But I was pretty sure the 55 line was going to be the bottom and hold, and this rising channel was coming up here, so we're in good shape. So they're getting into sports betting. That's how we got into it. We talked about sports betting, and Boyd is heavy into the sports betting and will expand their presence that way. And they're the right crowd. But you know, think of the OTB crowd, right? Like, you know, there's going to be, that's what they have in England. They have these bookies all over the place. They have, you know, professional bookie places. And it's like OTB. It's does everyone have OTB? I'm in New York. It's like a big thing. So anyway, so I grew up with people playing OTB. You know, nice people didn't go there, but so I did not go to too many OTB places, but I knew plenty of people who did, and they were too smoky for me for one thing. Everybody smokes, or did at the time anyway. But the bottom line is people like to sit in a room and watch the horses run around the track and bet on them, basically. Now it's football, baseball, blah, blah, blah. I think that there'll be some form of betting parlors with lots of big screen TVs, but I don't know if it can be a bar. See, OTB can't serve drinks. I don't know what the rule's going to be. But now that we have this sports betting, I think it's going to take off, and like people are going to go out at night and hang out and watch sports and bet on it and so on and so forth. And I think Boyd is the right company to capitalize on that. Also, of course, the online stuff as well. But I think for a night out with the boys, it's you know, it's like the sports rooms at Caesars and stuff like that. You know, it's fun. It's like you go down there and watch games with all the people who care, and they all scream and cheer and whatever, because they got money on it. It makes it more exciting. So I like Boyd, and in Boyd we got aggressive. We took the 55 spread. We spent $6,500 on it. So we're basically we put in the long-term portfolio. So here it's a $6,500 on the $40,000 spread, but it's already $14,000 in the money. So basically, it's the same kind of thing, because if it's flat, we're going to make our money. We sold the puts. So we're selling the puts, and we intend to sell more of these calls. So we're probably going to knock the 65 down to 0. And then all we have to worry about is it staying above 50. 50 is way down here. So, you know, you can't look at the risk as being, oh, you're going to have $50,000 worth of Boyd and it goes to 0. It's just not a realistic thing. It's exactly as unrealistic as me saying it's going to go to 150. It's probably not going to do that, and it's probably not going to go to 0. Somewhere in between is where we are now. But certainly 25 would be ridiculous. And again, you go back to the worst case scenario, which just happened and could happen again with a COVID lockdown. These guys went to 6. This was crazy last March. This was as crazy as 2008. No matter what it was, people just dumped the crap out of it. But that's what I'm talking about now. Low volume rally. This is a low volume rally. Although it wasn't really so much of a rally, but we are in a low volume trading environment. And if people come in bulk and try to sell, the price falls. The price drops tremendously. Once the price drops to here, and it's half of what it was, people start getting interested and come in and buy it. The bargain shoppers show up, and that's why you can have volume and rising prices. But initially, when they say, well, who wants to buy this for 36? Nobody. Nobody wanted to buy it here for 36. Okay, people wanted to buy it at 30, 27, 23, 21, blah, blah, blah. You know, people would buy it below 30, but 36, no, not a lot of interest. So once people try to unload in bulk at 36, they find out nobody wants it. When do people want it? Back at the normal channel. Some people wanted it here, not many, but then it failed that channel, and now you've gotten rid of all these guys who wanted it here. Now you don't have anybody who's interested until now you've run out of interested people. So you go to my normal Levi's example, right? And you say, okay, so you put a sign in the window and you say Levi's, which are usually $50, are now $40. 10, 20 people come in the store and buy the jeans for $40. Why? Because they really want a pair of Levi's right now, and it was on sale, so they bought it. But hundreds of people are going to walk right by that store and ignore it, right? You walk by stores all the time, 50% off sale. You don't buy anything. Why don't you buy anything? You don't want it. I don't care what price it is. I don't want it. That's what happens. Just because something's on sale doesn't mean somebody wants it, and that's a mistake that people make when they buy a stock. They think they can just sell it anytime they want, but you can't. And that's why these fad stocks are so dangerous, because people only want them as long as they want them, and then they don't want them at all. So those Levi's that are $40, okay, what happens next? Nobody wanted them $40. They still have too many in the back. They mark it down to $30. At $30 now, 40 people show up instead of 20. Okay, and 40 people walk by the mall and see it, and they go, "Oh, $30? Are you kidding me?" Boom, boom, boom. What's that? It's a 40% off sale. That's what you've done. You went from 50 to 40. 50 to 30 is 40% off. So 20% off, some people want it. At 40% off, more people want it. And then there's effectively a point at which you're basically giving away for cost. Let's say if you go to 50%, you're giving away for cost, and maybe more people come. But you know what? Not everybody comes. Because again, you've walked right past 50% off sales in the mall. You've walked past 70% off sales at the mall, right? Going out of business sales, things like that. You might look in the window and you go, crap, don't want it. Well, and you walk by. Because no matter what kind of quote bargain something is, it's, you know, you in your mind, your cash is for things you want. or need, not necessarily just for whatever happens to be on sale. And that's true in real estate. And, you know, if a house is not desirable, if it's not in a desirable location, if it's not this or that, doesn't matter what price you put on them, you can't sell them. I mean, in Italy, there's a good example. In Italy, they are paying you, or not paying you, or you're actually, there are some people paying you, but like Vermont will pay you money to move to Vermont and work there. You know, Vermont will pay you like $10,000 to move to Vermont. In Italy, they're giving houses away for $1, so basically free house, to get people to move, or not. You don't have to move there. You just have to renovate the home. That's the rule. These are old homes, of course. And in Italy, there are these abandoned towns, and they can't get anybody to come in and buy it and do anything. So what they're doing is giving the houses away and saying, all you have to do is fix it up. And if you get it up to code and do this and that, then you can do whatever you want with it and sell it or whatever. You know, so you don't necessarily have to live there, but you have to at least put your time and effort into the house. And of course, you can live there. And for people retiring, it's a wonderful thing. If you're handy, it's a really, I mean, you can go buy a house in Italy for $1 and go live there. And there's a couple of countries doing things like that. I think their states probably done. In fact, Detroit does that too. Detroit has something similar. You know, things become so undesirable. Even real estate can become so undesirable that it doesn't matter what price you put on it. Free. They can't get people to come for free. So this is a problem in a low volume market. Again, just think of the mall, right? Because it's a low volume market. There's not many people in the mall. So if you've got 100 pair of Levi's to sell, and only 100 people are going to be in the mall that day, you're never going to sell those Levi's. Doesn't matter what you say, free. You're going to end up with Levi's left at the end of the day, unless, I mean, somebody might just put them on their shoulder and carry them out and figure they'll sell them at a flea market or something. But realistically, people are just not going to buy them. It doesn't matter how much you mark something down. That's what happens to a stock. When you're in an environment where nobody is buying and everybody is selling, this is what happens. And if you can't wait this out, you know, you have to say to yourself, the world is not ending. And what were we doing here? We were buying. We were buyers back here in March because we had cash. Just like we do now, we had cash. I don't think this is going to happen again, although, and I honestly got to go soon, so I'm not going to, you know, I don't have, unless the Delta virus comes back. I don't want to get into that whole thing again. You guys know how I feel about it. Unless the Delta variant comes back, you know, gets worse, and we have to go back on lockdowns and so on and so forth. And by the way, that's happening in Asia right now. They're locking back down. Now, they're more paranoid than we are about it. They don't want, they certainly don't want to have our kind of numbers. You know, in countries where there's 1 billion people, they don't want to have the kind of percentages that we have of sick people and so on and so forth, because their hospitals will get completely overwhelmed. They don't have the kind of money we have to spend on these things. So it could be a huge disaster, and you know, countries can spill over. It becomes political unrest and everything else. I mean, hell, we have political unrest in California just now. We just they had a recall vote on the governor, and initially, the way that got traction was because it's the way you frame the question. In other words, when they're in Democratic districts, they said, do you approve of Newsom's handling the COVID crisis? And since the Delta variant was back, even the Democrats were saying, well, no, I don't. We should be over this by now. Why is it still going on? Why are we still locked down? Why are the businesses still closed? Blah, blah, blah. So even the people who voted for him or were likely to have voted for him, they still had issues with the way the COVID was being handled in California. Obviously, the Republicans, you know, basically completely blamed him. So it looked like it was going to be a close vote to recall the governor. Now, since the recall election started, since the campaigning and everything started, what happened is people became more aware that this Delta problem is a worldwide global problem. See, again, the problem with the GOP in California is they have an educated population, and that's a Very, very bad thing. You need a much less educated population to sit there and bullshit them. So the people began learning more about it and found out that this, California was not in fact handling it poorly. They're handling it as well or better than almost any other state. Plus, that state has a huge budget surplus. California runs at a profit. I don't know how you can possibly be pissed off at the governor about this. Anyway, so they just failed as far as recalling him. But yeah, it's all timing. Yeah, and it's like in England when they call an election. The government that's in power in England calls the election. Just any random time, anytime they feel like it, they call for an election. So obviously they wait until it's a good time to call for an election when people are supporting them. But the problem is, in the short amount of time that from when you call the election until then, something bad could happen. And then people swing and turn against the party. It does happen once in a while that the party can suddenly lose the election that they called for. There's also a certain time limit, but they always, they try to pick a spot that works for them for these elections. Anyway, so, you look at the worst case, but you think he's had a realistic worst case. The worst case really for Boyd is more like, $15, $20, that would be a worst case. But we think that this gaming and the sports betting and so on and so forth is going to be a much bigger thing for them in the future. That gives them a huge growth upside, and we definitely want to be into this one. And we think it's going to really take off. And again, you go back to Boyd, you look at the nuts and bolts of them. And they chug along 2.632. No, wait, sorry, two. All right, so 2.633. That's an abnormality. 2.133 again, though 3.4. So whatever. Oh, no, actually, this was more an abnormality. I'm not sure what happened here. Oh, I'm sorry, it's 2020. It's last year. They were closed. So even when they're closed, they had $2 billion. That's what I liked about them. They have very little loss. 135 million is not a big loss. They made 400, 200, 100, 150, lost 135. That's all that happened in the last year with a huge hit. You got to love that about the company, right? It shows that they are able to dynamically adjust their business and absorb the issues. And then they come back, and now they're making some really good money. People are back and paying again. So they're making $500 million, and you can buy the whole freaking thing for $6.5 billion. And long term, we see a very bright future for them. That makes it kind of a no-brainer investment for us. We think they're very undervalued and great growth potential. That's a good combination. All righty, so that's that. Let's see what else we got. We did Dow Chemicals. I love specialty chemical companies. So that goes back to the thing we talked about that at the previous webinar. And Dow's still not doing well, still a great trade. So, it's all, you can just go do the top trades and you'll be fine, basically. There's always plenty of good ideas in there. And then today, or not today. Ooh, what happened? I got knocked out. So, because we went to cash, if there's a nice bargain, we're picking them up also. So for example, if I can get this thing to resolve itself, there we go. Not there. I guess, was there one yesterday? Looking for something blue. Oh, here you go, carbon. Oh, I like this. Holy cow. Oh, did I post that PowerPoint on them? 2 of them. Hang on. Oh, no, I didn't. I thought I did. Oh, well. There's a really good PowerPoint on these carbon guys. Anyway, so it's an ETF, and they're following the carbon credit futures, and I'm getting into the dynamics of this because we're working with our hemp farms, and we are on the project that we're doing with a New Age from PSW Investments. We're working on these hemp farming, raising capital, and we're going to sell carbon credits. And it's a very interesting market. Oh, I wish I had this PowerPoint. It's a very interesting market, and just trying to think of the numbers are staggering. I think there was $300 billion or something of carbon credits were traded last year, and we need to trade more like $1 trillion. We need to trade about $1 trillion a year to begin balancing and getting towards where the Paris Accords want to be. The problem is that these carbon credits are the low-hanging fruit. They are like the forests that International Paper grows and things like that, like, you know, massive amounts of parkland and so on and so forth that generate carbon credits, farmers generating carbon credits. It's not easy to generate carbon credits. And so all the credits that were around to be sold have been sold. And there's not much new stuff. Now, this hemp thing is very exciting because you have to, you know, you can grow a crop that is carbon negative, right? That will suck up carbon. And that's great, but then what do you do with it? Because if you're just growing it for the sake of the carbon credits, it doesn't generally pay enough. Not many crops have enough density for carbon credits to make it, you know, maybe you don't pay $100, $200, $300 an acre, you know, for a crop, and then that's not enough to incentivize the farmers to switch to it. It's not the value proposition they need. With hemp, we can sell the hemp, and the way we've come up with selling the hemp is we're turning the hemp into plastic and into paper products, like cardboard boxes and things like that, and even pallets, and you know, for the pallets for moving stuff around on ships and containers, those can be made out of hemp too. So hemp can be, it has a very long fiber strand. So in other words, when they break it down to the molecular level, the long fibers of the hemp are very long, and because of that, they make a tough molecular chain. That's why hemp was used for rope and things like that. And because of that, though, it can be emulsified and turned into something that's more or less like a plastic. And that means that we have the ability, because plastic is 10% of the oil market is plastic. You know, it's $500 billion a year, the plastics market. So there is a almost unlimited need for plastic if we can replace oil products with hemp products for plastic. And that means we have a reason to plant all these fields. And now we have a reason to grow hemp in all these places. And because of that, we now can generate hundreds of millions of dollars of carbon credits. See, it's a side thing. It's like a rare earth, because a rare earth, the problem with rare earth materials is generally that 99.99% of what you're digging out of the ground is not what you're looking for. So it's very hard. So usually there are byproducts of some other kind of mining that you get these rare earth minerals. That's why they're rare. They're not rare because they don't exist. They're rare because you're not going to dig up 100 tons of gravel to get 2 ounces of tellurium or something like that. You have to have a reason that you were digging it up in the first place. So usually it's other quarry work, other mining work, and so on and so forth that does it. You know, same with gold, right? You're sifting through a whole mountain to find a couple of pounds of gold. I mean, it's not a, you know, it's not that easy. So the point is that these carbon credits are much harder to generate. This is the problem. You think these are going to be easy to make, but they're not. There's only X amount of carbon credits that are possible, kind of like Bitcoins, right? So the price is always going to go up. Then you've got mandated demand. And the mandated demand means that companies are forced to become carbon neutral, and they either do that by cutting their carbon production or by buying carbon credits from people who are carbon negative. And that's how the market is. But there is not enough carbon negative production to make up for the people who pollute, and it'll take a while for that to imbalance. So prediction wise, these should go from like probably here to about 200 before they're done. And that's over the course of the next, 7, 8 years. But still, that's a great growth path. So why not be on it? So we're going to start watching it. We're just selling 10 of the January puts because they don't have very long-term contracts. So we're selling 10 of the January puts for $2. Now, that's about September, October, November, January. All right, so that's 4 months. So for 4 months, we're going to get $2,000. If we get $6,000 a year not owning this thing, that's pretty damn good. But eventually, I figure they'll probably get more popular. This is a pretty new ETF. They'll probably get more popular, and they'll be easier to buy longer term options. But right now, this is the easy way to get it. But this is a great little investment. I'm very gung-ho on these guys. And I'm gung-ho on the whole carbon credit market. It's just the math of it indicates that it's going to be a very good future growth scenario long term. All right, so that's my pitch on KRBN. And here's my buddies at Lockheed Martin. And what do we like about Lockheed Martin? Fusion, baby. And they actually they had a fusion project. They were very gung-ho working on it. It got kind of put on hold because they started working on drones. That's what happened. The people in the same people who were working on the fusion project, or a lot of the same people on the fusion project, got assigned to the drone division because drones took off in the last few years. And the Lockheed Martin guys are working on the drones more so than the fusion reactor. The fusion reactor, they couldn't quite get what they needed out of the yields that they needed. So their deadline, they expected to have a working fusion reactor by 2025. And I think what they've done is they sort of paused it a little bit, waiting for some of the science to catch up. So they're like waiting for some more testing, more breakthroughs. Everybody in the fusion space is part of this Paris project, IT something R. Anyway, there's a massive multi-billion-dollar fusion project in Paris, and everybody is contributing, and everybody is benefiting from the research there. So there is sensible corporately to step back and allow them to move forward and get to the next step before you start going back to the lab and doing trial and error. Why repeat the process? And fusion is going to happen. It's just a matter now of incremental breakthroughs, like when electricity, when we first started dealing with electricity, they had all sorts of light bulbs, but they couldn't quite get it right. And then Edison tried 10,000 times to make a light bulb and came up with finally the proper way to make a light bulb. They had light bulbs, they had things that made lights, they had arc lights, they had all sorts of little things that would do something to make light, but they didn't last and they weren't practical and they were too expensive and blah, blah, blah. That's where we are at fusion right now, except at the moment we can't sustain a reaction long enough to be practical. That's, early stages, but it's not an unsolvable problem. We're out of the realm of like science fiction and into like, okay, we have to figure out how to get from here to here, but it's definitely going to happen. Like when they made a submarine, they had to figure out how to make a submarine that could go this deep and then that deep and then that deep and then that deep. The concept was there. Da Vinci sketched out a submarine as a concept 500 years ago, or whatever the hell he lived. About 500 years ago. But it took, 50 years, 100 years of engineering to get a real submarine working. But it wasn't that it couldn't work. It can work. It's just a question of getting it right. Same thing with quantum computers. We have quantum computers already. Again, people have to get it right. So they're still messing around with it. But they're incremental steps to getting things. So fusion will be a thing. Lockheed Martin, definite leader in fusion. I love them for that reason. And of course, leaders in drone technology, which is going to be also life-changing. I mean, it's going to be perfectly normal to have drones like Star Wars. Like in Star Wars, there is the new Star Wars things have lots of drones. Like everywhere in the cities, there's drones everywhere, and that's going to happen. That's how things will get delivered. Things will be delivered by drones. Mail will come by drones. Things will get dropped off. Packages will come by drones. Food will come by drones. So there's going to be a lot of drone traffic. Company like Lockheed Martin, cutting edge for that sort of thing, and it's the right time to buy them. They haven't been this cheap in a long time. They were, well, again, back to what's the worst that can happen with all these guys? And then they had as big of a sell-off. No, they went down. I mean, they went with everybody else, but 255. So their worst isn't as bad as other people's worst, of course. They dropped not even 50% here. It's like 40% or whatever to the very bottom, and then they settled down pretty quickly, 300. So from 400, 330 something percent. But now they're at 350. So if they're going to settle down at 300, we're fine with that. That's not a big percentage drop. We can deal with that. Where did I just put that? Here. Nope. There. So on Lockheed Martin, we like this play, and it's a big spread. It's a $70,000 spread, net 40,000, net 14,000, 40. It's 42,000. Again, this one's $42,000 in the money. We're not going for a home run here. We're buying the 300 calls, right? Which is where we said it would settle down. We're buying the 300 calls. We sell the 370 calls, which is right here. So we're already this much in the money. So we're just betting this is going to hold and it's going to go higher from here. But we're in great shape on this trade already, just to start. Oh no, that's a different. Damn it. Okay. So the bottom line is, look, we're finding bargains, we're picking things up, and because we have the cash, we're able to make these moves. We're hoping. I don't want to say we're hoping. I mean, we are hoping something happens. We're hoping for a nice little turn down where we do get some bargains. Not, hopefully nothing that's drastic, because that just sucks for people. But it would be nice if we got like a 10% correction, a 20% correction, and we could jump back in with both feet. But meanwhile, having the cash into the holidays is very defensive, because this is the most likely time of year that something bad is going to happen. Again, the virus is either hopefully peaking. Hopefully the virus is peaking, and it's going to run out of unvaccinated people to infect at some point. That would be good. The question is, how long do the vaccines that we have last, and what are we going to do? And is the government going to just keep giving us free vaccines forever? We'll have to see what happens. But we're hoping that hopefully we normalize with kind of the situation we're in now. Sadly, it's going to be. I'm not sure how much we're going to hope for, really. I mean, I just think it's going to be very hard to get back to normal. Now, I say that, but I'm in Florida, and Florida is back to normal, if you call it normal. I mean, people just do whatever they used to do and don't care. It's still, and we are the worst state in the country. But I think we're probably about 1/4 of all the COVID cases and all the COVID deaths are in Florida for the whole country, and we only have I want to say 20 million people. You should know that, right? Florida population. Yeah, 21 million. Okay. So yeah, we only have 21 million people, and we are 1/4 of the country's cases. So we're something in the neighborhood of three times, or 4 times, or yeah, about 4 times, no, 3 times. So we're about 3 times worse than the average state. But that's because we're crazy. So I don't know. I want to use it as an example, but I mean, people are just. It's no difference. You can't tell where I live. You cannot tell that there was ever a problem. There's just a very, very few people walking around with a mask on the street, and they're probably tourists from up north. And everybody's just packed in these restaurants and packed in the bars and sitting shoulder to shoulder. And there's nothing, there's no social distancing. The stores, nobody wears, the store people don't wear masks, the customers don't wear masks. So, you hope these vaccines work, but the question is, how long do they work? And how often do we have to get revaccinated? And is this going to be the rest of our lives? So, I mean, until we have answers to those questions, I just would prefer to be a little bit cautious. That's all I have to say about it. So into the holidays, since we really don't know what's going to happen. Where's that? I lost that chart now. There it is. So into the holidays, because we really don't know what's going to happen, I just don't see the point in taking too many risks. I'm not saying we don't buy anything. I'm not saying we don't go for bargain stocks or things like that. But, look how far we are above the 200-day moving average. We're 10% over the 200-day moving average. That's just way too much. It doesn't take much of a change in sentiment now. Also, we're only going to get the stimulus we've been promised. We're not getting more stimulus. We're not getting surprise stimulus. If we get it, we're only going to get what we were promised. So I don't see how that's going to really excite anybody. So I think what we're in danger of now is losing this 50-day moving average, which is at 4430. All right, and where was the S&P? Not that. So you see where we bottomed out right here, right here? That's the 50-day moving average, 4430. That's what we bounced off. So, and coming down from 45.50, it's 120 points. So your bounces should be 25 points. So 44.55 would be bounce number one. That's right here. And then 25 points above that is 70. Oops, right here. That's a strong bounce line right here. No, it's 80. Sorry, 80. I apologize. So 44.30, 44.55, and then 25 more is 80. So 44.80. This is your strong bounce line. And that actually makes more sense. You can see how it was touch, consolidate, touch on the way up, and fail. And probably we're going to get another fail here and consolidate for the move lower. But when 44.30 breaks, we're going to have a pretty big move down that's going to get us into that zone and get us into this zone between the two moving averages. And then depending on what happens there, if we hang out here and consolidate for a move back up, that'll be very bullish. If we end up falling deeply down here, what's going to happen? We're going to pull the 50-day moving average lower, but since we're still above the 200-day moving average, it's going to continue to rise, and that sets you up for a death cross, right? That's how you can see. That's how come you have a huge advantage. If you understand how a chart works, you have a huge advantage over technical traders, because technical traders only look at the chart backwards. And they don't think about how the chart is being formed. It's like, what causes it to be formed? Well, this is a 50-day moving average. So the average of 50 of these is this number. So 50 times, 50 of these averaged out is this number here. So what happens if this number, what happens if the next number in the series is 50 points lower? Well, then this number drops 1 point, right? It drops 50 divided by 1 lower. If we're 100 points lower, it drops 50 by 2 lower. Very simple, right? We know how this chart is formed. We understand that. So therefore, the minute you start seeing the breakdown and you see how severe the breakdown is, you can start sort of extrapolating how much is this going to tug on this 50-day moving average? How much is it going to pull it down? And then how far in the zone are you? The worst thing for a death cross is when you're hovering around here. When you're in this area, because you're still bringing the 200-day up and you're dragging the 50-day down. How many days does it take? Well, the other thing about the 50-day moving average is that you're throwing out the old data. Keep that in mind too. That's another thing people don't understand that about the 50-day moving average. That's why it suddenly turns down. Not obviously in this rally, it never turns down, but that's why you get these sudden turn downs in the 50-day moving average, because after a certain amount of time, this series gets thrown out. So this entire series that would be supporting you, obviously this would be, all right, so let's say that's 20 days, 40 days. Let's say this is 50 days here up to here. Figure 20 days a month of trading. And don't forget it's 50 trading days, not 50 calendar days. So let's say this is where the trading is. Now, what's going to happen is you can see this, 19th. So right here, this series here will get thrown out over the course of 10 trading days. So in the next 10 trading days, we lose these numbers. So there's a double effect, because if you're still down here for 10 days, well below this, what happens is these all come into play, and now you no longer have these higher numbers that support and offset them. So suddenly the average can fall down, even though you would think it's not going to, because this average is being supported by this data, which will be taken off, and then you can only calculate this group. And if this group is mostly down here, all of a sudden the average can drop off sharply. If you're below it, it's even worse, right? It can pull it down very quickly. And that's how you end up getting these death crosses. You're below the 50, but above the 200. So the 200 keeps rising, the 50 starts going down, big trouble. And that's when the chart people freak out. But we can tell a month in advance, 2 months in advance, when the chart people are going to freak out. So far, this is just the same kind of dip as these, where we bounce off the 50-day moving average, except what happened? What's different? The difference is 1, 2, 3, 4 days down here. Here's 1 day, 2 days, well, 2 days, 1 day, 2 days, 1 day. Okay, 3, 4 days here. Today's going to be another one. Okay, we're consolidating at the 50-day moving average. You're going to bounce off the 50-day moving average, but if we're consolidating there, we're not consolidating for a move up, most likely. We're probably consolidating to break below it. So it will not take very much bad news for us to pop lower, and then we'll see what happens. But again, most likely there's no support, there's no base. This would be the same 200-day moving average. This is really the 40-week moving average, but it's about the same thing. You can see that there's been no support. We had this huge gap up. We never really retraced, and we've been hovering up over here. So this needs to get filled at some point. So there's 2 ways it can be filled. It can be filled because we consolidate here and stay there until the average catches up, and that's, by the way, a very bullish thing when that happens, or we can start coming down to meet it. And that's just a question of whether we have good news or bad news. But then, of course, our overall calculations are that the market is very toppy here, that we've overextended, and that at least down to 4,000, at least a 10% correction is in the cards. So what's much more likely to happen, I think, is a 10% correction, which we have decided by cashing out the portfolios to skip. Rather than ride it out, we've decided to skip it, and we'll see what happens. All right, so that's all I got time for today. In fact, I'm over my time. See if there's any questions of any kind. Nope, no particular questions, so I feel good about that. Thank you all for coming. I appreciate it, and we will do it again next week. All right, take care. Ugh.